Welcome to the Dividend Talk podcast, episode 160 Dividend Investing on a Budget. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJ. How are you, my friend?
Oh, really good. We are early for the weekend. I'm really much looking forward for the weekend because I have some nice family time coming up. But yeah, really doing well. How about yourself?
Good. It's how would you say summertime over here? It's been raining for most of the summer. We have a status yellow weather warning now, but I'm looking forward to the weekend. My son's playing a match tonight at 7 o'clock, and that it's his first, I'd say, game for a professional side. And I'd pity him going out into that weather, I have to say. But it's going to be a good weekend. It's going to be a good weekend. It's hectic in work. I know I've been speaking to you all week. I've put in a long shift this week, so I'm glad we're doing this early. And tonight, I'm going to have a few beers. We're going out at work, and I'm just going to switch off and enjoy it. But looking forward to the show. I think it's a good little topic that we have actually.
Yeah, definitely. And the year goes so quick, right? We mentioned it already before. It's already half August, so before you know it, we're already in the run up to the end of the year. But was there anything that caught your attention this week in the news?
Yeah, pretty much. After last week, I think we spoke about Siemens quite a bit. We got some questions, and I was browsing through the Hiro or the Giro for the first time, I think, in about a month and a half. And that has a nice little news section there, and it actually popped up about Siemens. And what's really nice about this is that they are beginning to manufacture some solar energy equipment in the United States. And this is going to be a partnership they have with another company over there, with another manufacturer. But I think it's interesting because it aligns quite nicely with President Biden's law, this whole incentive to try and challenge China. So they're trying to get all this energy supplies back into the United States. And it's interesting to see that there's a European company taking advantage of that. One of the first companies, I believe, actually to take advantage of that. So it's quite a good model. I think there's a huge scope. I mean, if you're looking between Europe and America, obviously America is probably the better place to start this. I would think the conditions seem a lot better for the most part with solar. But it's as I said, it was eye-catching that it was definitely a European company taking advantage of this rather than an American company. So big up to Siemens on that.
Yeah, and what I like is that Siemens is trading out under 33 euros, right? So for me, that's kind of a fair price. Of course, it's cyclical, so I want to buy it much lower. But I'm already eyeing this stock because I just really like Siemens. It's really a good company. They had, of course, a small dividend reduction when they spun off Siemens Energy. But other than that, I mean, really, really nice company. I mean, we discuss it so often here.
Yeah, we do. And what I like is they're not actually making the solar panels. They make the equipment needed for them. So I think
nice.
I think that's a win-win, because if solar panels don't take off, but they still need to build them at some point. So they're going to need to use their inverters and so on. So I think it's a win-win. And like you said, they are a decent price. I wish they were under 100 again. I remember it was the new T130 Siemens under 100 at the time, but it's I think they're a good price. It's a European mega company, so I'm all for them succeeding.
Nice. Well, not every company is doing so well as a company like Siemens, because it's a company we never really discussed here on our podcast. But the Finland-based real estate company, which sells which buys apartments and rents them, let's say, Kojamo actually announced to cancel their dividends, which is really interesting because the real estate market in Europe is really, really tough. We see that also Vonovia. So a little lesser known stock, Kojamo, canceled it, and they say it's because of higher interest rates to hit their interest expenses, threatening profitability. And here I want to, how is it? Here I would like to remind people again about how important and how different dividend policies are in Europe, because their dividend policy literally mentions, like, Kojamo's objective is to be a stable dividend payer whose annual dividend payment will be at least 60% of FFO, provided that the group's equity ratio is 40% or more, and taking into account the company's financial position. So, this shows you clearly that they only want to do a share of profit. And for companies without a strong track record, I really shy away a little bit in investing in those. If you compare again about my darling Ahold Delhaize, they have also like a share of equity, but they also like when you read between in the lines, is sometimes even a bit more articulate. They just want to continue growing their dividends, and they have a business model that allows them to grow slowly earnings over times, and they've proven that they sometimes went higher, that they continued paying the dividend and hiking the dividend even if they had a bad year in between or a bad quarter. So that's what you need to look at then for European companies that are not explicitly saying a progressive dividend. What I also found interesting when I read the initial, I said the press release, they mentioned like Kojamo to start, change negotiation regarding its employees. So they're not only making the shareholder suffer by canceling the dividends, but also they will start renegotiating, I guess, salaries with their employees.
Yeah.
And then the quote here: the negotiations concern all the employees of Kojamo except the CEO. I mean, this had me cracking up. I mean, everyone needs to suffer, shareholders, employees, but not the CEO.
No,
the CEO is
he's top dog. He's top dog there. He's there for a reason. But I mean, if I said it to you offline, but if you're an employee there, how do you feel about that? Everybody else is going to suffer except for the man who's making all the decisions, who's probably caused this.
Yeah, and who gets an increased salary compared to everyone else because the increased risk the person has in the job, but seemingly not a downside risk here. I mean, this is so funny. This is so funny, right?
That's the company I want to be CEO of.
That's the company I would never want to invest in.
No, never invest in. But if I was going to be a CEO where you're relatively safe, that's the one. That's the one.
Yeah. Anyway, I hope, really hope that some of our listeners don't own Kojamo, because it's not nice to see your, entire dividend wiped out for this company, right?
Yeah.
Because they are totally canceling it for 2024.
But it highlights some of the differences, doesn't it, between real estate investing in Europe and in the US as well. Particularly when you read the first line, at least 60% of FFO is still, and we know that with REITs it's typically 90%. So
because they're not a real estate investment trust in Europe, that's a big difference.
So I think that's important for listeners to understand as well, because you can get caught out with that. They might call themselves a real estate investment trust, but it's a lot different to the American vehicles that
because in America they also have a tax advantage, right? Which European companies actually don't have here. That's what we learned when talking to the DFAMA CEO, who mentioned that it's a part of earnings, right? And they just pay normal tax and everything, because there are also downsides to those companies at the same time. And he wants to have the flexibility to grow and to invest. So it is something to watch out for, and it just shows how difficult companies have it, specifically because they are building apartments or renting apartments to normal everyday citizens, right? From what I understood. So it just shows how difficult this market is, and But look, hey, forget about this one. We forgot last week about Novo-Nordisk. They hiked their dividend from 4.25 to 6 Danish crowns for the interim dividend. I mean, what is it, a 40% hike or something like that? So kudos to everyone who owns Novo-Nordisk. Kudos for everyone who held on to it and never sold because it was too expensive. I mean, the stock is on fire. We all know that because of the, this kind of weight loss drug that they are selling. I also heard that Viatris is targeting a generic on this one, or a biosimilar, I believe, on this one. So I'm also curious how that will play out. But yeah, Novo Nordisk. I mean, what was it? Last week there was a news item here that I think they are having 50% of the entire Danish stock exchange is entirely contributed by Novo Nordisk.
Wow.
Yeah, so when they sneeze, the entire Danish economy gets a cold. That's how it sounds like.
Yeah, it's quite a peculiar position to be in, and I would say not the ideal scenario for if you're the Norway economy, because as you said, if they sneeze, they get a cold, and it's quite a big company. But look, they're doing all the right things, aren't they? Over the last 18 months, they're performing pretty well, and this weight loss drug that everybody seems to be using is working wonders for them.
Well, it's hard work, right? What Novo Nordisk is doing there, but their strategy is really paying off. But it also feels like they found a gold mine. Yeah, they found it and they're able to fully exploit it. So kudos to them, really.
Nice.
Good. So the main topic then: what does dividend investing on a budget actually mean? And yeah, can you explain a little bit about this topic as well, Derek? I'm really interested to hear your thoughts.
Yeah, dividend investing on a budget, and it kind of, I was thinking about this because I think as an investor myself, I would have started dividend investing really on a budget. I started when I was just coming out of college, going into the workforce for the first time as an engineer. I'd left my previous role as electrician, and your cash flow is not as strong when you start in your career as it is, particularly 5, 6, 7, even 10 years down the line. So you're looking after all the bills. You might have some debts that you have to pay off, your family commitments. You have lots of things. So I would call something in and around under 10% of your disposable income afterwards is probably you're on a budget, and you're quite limited on what you can spend on. In terms of monetary value, that could be anything from $50, $100, €100. My first investment was actually €50. I think I started going up incrementally to about €200 and it finally set at 1,000. But for me, I don't think that the value matters as much. I think it's the percentage of your overall income and how much you can afford to pay based off that. I think a lot of people, as I said, particularly starting out, will have a lot of different commitments. I think loans and debts are probably the biggest people have, along with family commitments, especially if the family is quite young.
And specifically also when you're like mid-20s, still late 20s, you probably just got your job like a few years ago. You've been maybe saving up for a down payment. You just buy your first house or apartment. You're probably leveraged all the way to your neck, because for that generation it's really, really hard to buy anything. The same actually for us at the time, I would say, but it continues to get worse. So there's probably not a lot of money left at the end of the month, right?
Yeah, and it's quite intimidating then if you're in that position. You've got only maybe, let's say, 5, 6, 7, 8, 9, 10% of your disposable income left that you want to invest. But it's intimidating because at the same time, you don't want to lose that money. And I know that the saying goes, don't invest what you can't afford to lose. But really, when you're starting out like that, it might be left over, but it is still money that you could definitely do it, not losing completely. So I think for me, that's the definition of investing on a budget: is under 10% of your disposable income, and you're really on a shoestring in terms of what and when you can buy different companies or invest in different companies.
Yeah, and when you say investing on a budget, right? I think we've all been there. I mean, I mentioned 1 or 2 episodes before that I had only like €100 to save or something like that, went to my savings account. And if I look back at things, right, I can remember that I didn't think about investing, because I was first making sure that I paid my mortgage down. At the time, I had almost 5% mortgage interest rate, because I got my apartment then in like 2007, just on the brink of the financial crisis. My apartment went straight away down in 30% in value. I mean, talking about buying at the top and selling low. So I was focused on paying that down to a reasonable level. And you know what? That gave me then a breather to start investing more, because if you pay down your mortgage aggressively with the 10% of So maybe a step back. First, I made sure I had like 2,000-3,000 in savings on my savings account. I didn't need more. It was kind of my emergency fund, not realizing it was my emergency fund.
Yeah.
Yeah, I just thought after that, okay, let's make sure I pay my mortgage quicker down so that my bill gets lower. I was not focused on I said increasing my net worth. I was purely focused on bringing my mortgage bill down. And this is also what I think is important. Honestly, if I would have like, let's say on a 2,000 salary, 2,500 salary, 250 euro per month, and I would have a mortgage rate today with what I have now with 7%, I will probably not invest yet, but really make my expense bill lower at that time. Now I don't need to, because I can play the opportunity cost game. Yeah, I've got a 50% savings rate, so you can easily say like, okay, my 8%, what it is now, my mortgage rate, I can over time get 10% annualized on that money. But if you're in your really early days, I would not play that game of opportunity costs. I would really just bring down the bill first, because when you bring down the bill, you get to get more money later to invest as well. And I think it's not so much about being the smartest in money management, because it's probably not the smartest to pay your mortgage back down. But what I want to mention is like the stress level goes down significantly, and that's money can't pay for that. Yeah, and we know what stress can do to marriages and relationships, to just mental health in general. So that's really what I would focus on. And once you have done that, let's say you've paid down 30% of your mortgage or something like that, this 250 euro becomes, I don't know, 400 euro. Yeah, you say, and also your salary will increase in those 3-4 years at the same time. Yeah, because usually your mortgage kind of stays the same, but let's say your salary grows with inflation. This 400 euro after 5 years might have become 600 or 700 or 800 euro if you're able to kind of keep other expenses a little bit under control. And then you're talking about a nice monetary value of, let's say, 700-800 euro per month to invest. But even so, when it's 10-15%, I want to be clear as well, with such a savings rate, you will not probably retire early. If this is something you can consider maximum of your money, you will need 40-50 years to be able to retire early on that. So I would also assume that people's goals shift from retiring early just to buying freedom. For instance, work 32 hours a week or 24 hours a week at the age of 50. Yes, you can, when you live in the Netherlands, go with your bike into the city. You don't take any more, I don't know, consulting job where you need to travel the whole country.
Yeah.
Just, stay in the city with your bike 3 days a week. And then you have a nice little nest egg with retirement.
Like you'd wonder how many people, everyone likes to throw it around, retire early, but you'd wonder how many people actually want that as a realistic goal. If you were to sit down and set yourself a realistic goal, do you actually want to retire early? And what would you spend your time doing? And I think a lot of people, and I just know this from friends and family and interactions I have outside, even in my own workplace, people get to the age of retirement particularly, and they're fighting to stay on because you're just so used to working and doing something and keeping busy. I think everyone likes to have a holiday and a break, but I couldn't do it. I don't think I could not work in any capacity. I have to do something. If I wasn't, I would get bored. I would. I just would.
I would need to do something intellectually, but that's why I'm not such a big fan of the FIRE movement as such. Yeah, because I don't believe, and that thought has shifted, right? In the beginning, I was all about retire early, escape the rat race, but how I now think about it's really financial freedom.
Yes.
I don't need to have a paid job anymore. I can work for an NGO. I don't know. I work in IT. I could give computer lessons to kids here, like 2 days a week in the afternoon at the local school here, whatever. Yeah, something like that. That's for me financial freedom. Still, I will be busy. With that, I also would like to be a bit closer to society than locked up somewhere in a corporate or something like that. So those are more the aspirations that I can see myself working towards too.
Yeah, but I think it's a very, very good point though. depending on the amount you're investing, you have to set realistic goals. You have to look at it and think, if I'm only investing 5, 10, 15% of my income, I'm not going to be in a position to replace my income in a reasonable, well, I say reasonable, in a decade or 2 decades. It's going to be 30, 40 years down the line. So I think you have to be a little bit realistic in your goals and what you can invest. I think that's the very first thing I would say to any investor starting out. No matter what form of investment you're doing, if you're putting in a small amount of money, there's no such thing as a free lunch. You're not unless you strike it lucky and hit the next, I don't know, Apple buying them a 40 and they go to like $1,000 or something. But it's really a long game. That's how you have.
But let's take this kind of hypothesis, right? Because I went through this phase a little bit. But let's assume that here you have your mortgage at a reasonable level, and this 10-15% is really yours. Yeah, you get your emergency fund and such. There are so many examples of people that started to investing that were actually able to increase from 10 to 15, 10% to 20% or something like that. Because what people build with this dividend growth investing and, for instance, doing dollar cost averaging, you build a mindset. Most of us get addicted to the money that we see coming in with the dividends. You start with €1 here, €2 there. And a guy on Twitter, Leven van Dividend, he has also its own YouTube channel. He does it in Dutch. I saw him starting also with, was it €250 per month or €300 per month? Yeah. He's now doing 200. Yeah, he's now doing €250 per week. It's all mindset. Yeah, and then you start to focus more on money with your mind. And of course, it shouldn't go against. It shouldn't become materialistic that you give up your relationships for that, of course. But for instance, you start also maybe thinking a little bit about making money. You get your dividends, you start reinvesting them. So this €250 per month can quickly become 500 or 600 euro per month, because you start finding ways to save. You start thinking like, oh, you know what? Actually, why am I paying this always? Why am I having this behavior to money in this situation? Maybe I don't need it. Yeah, maybe I take the bike a little bit more often in the summer instead of all the time consuming fuel with my car. Do I really need 4 subscriptions with my family on Netflix, Disney Plus, HBO, and I don't know, something else still, right? Probably not. So this mindset is so important there. So I wouldn't be surprised if people that start with 10% on a budget actually, because of their mindset change and their addiction to the dividends, start easily going to 20%, 25%.
Yeah.
But having said that, how would you invest this kind of money? Would it be different from how you're doing it today?
Yeah, I think so. And I go back to when I started and my experience doing it. And when I was putting in $50, $100 at the time, I didn't really give much thought into the different areas, such as fees. I completely ignore fees for the first, say, 2 months, right? So I was putting in, I think I put in 50 and then I put in 100, and I'm nearly sure I put in 200 on the 3rd month. And when I was going through after the 3rd month, I was looking at it and I was buying as many companies as I could with them. I wasn't really focusing on buying all of the one company. I didn't give any thought to that. So I was buying Red Electric, Gambia. I remember Waco was another one I was buying. And then I realized, hold on now, I'm paying, bear in mind, this was with the Giro as well. So the fees were quite low. But I noticed I am paying fees 3 times if I'm buying 3 companies. So that starts to add up, and it eats into your, particularly when you're at a low level, it eats into it quite quickly. So I would definitely I would focus on a really, really small universe of stocks. I would probably pick 3, maybe 4 at a max, and they would be, I'd buy 1 a month, 1 this month, 1 next month, 1 the next month after, like that. But it would be really small, and I would try and keep my fees as low as possible, and I would keep my stock universe as low as possible. So I really get a good understanding of the companies that I own, particularly if I'm only starting out and I'm nervous. I'm not sure about my money. I would keep it relatively small, and probably some of the top names in the dividend growth investing world. Probably like Johnson Johnson's, probably like your Siemens if you're in Europe. I would stick to those types of companies.
And what about no commission fees, no commissions, no fees, and fractional shares like on Interactive Brokers or on Trading 212?
Yeah, see, I'm not a huge fan of Trading 212 as a whole. I know they do the pie, but there is a lot of regulation that I don't really understand. I'm not too clear on the Hero or Interactive Brokers either, by the way, but I always feel Interactive Brokers, I own the shares. I get daily notifications of everything that's happening. The dividends come in on time. I found when I was with Trading 212, I didn't get that.
But you do own the shares in general, right? Although they might be named under the broker's name, but the brokers, when you are a broker in Europe, you do need to keep a record of who the claim has on the shares. And I forgot the name in English what it is, but those are our shares, right?
Yeah, but the question I always had and stuck in my mind is, it's no commission. Where are they making money from?
So Trading 212 makes the money on the spread. So if you buy, let's say, there's something, you will notice that you might not have bought it for $60, but for, I don't know, something between 59 and 61. Yeah, because I can see that when I put my money in there, I can, if I invest 1,000 euro or 1,000 zloty in fractional shares, I can see that suddenly I'm a 0.5% or 1% on the minus. Yeah, and even if there was nothing happening really in the stock market.
So they're not really looking for long-term investors. If you make the money on the spread, you need people to buy and sell.
I think such companies benefit from that. I also feel they also earn from lending, and from their dark pools. So they make a lot of money on that, and that's why they are able to do this no commission trading. So that is the same like Robinhood. That's how those companies earn money. I think there's a mutual agreement here, I think, between the investor and the broker, that there's elevated risk on the broker, but in return you get no commissions. And the risk is, of course, if the person that lends your shares cannot pay them back, kind of, but that hardly ever happens.
Yeah. But to go back to your question before I went off on a tangent on Trading 212, in terms of fractional shares, I think someone like Interactive Brokers, I think it's a good idea, because one of the drawbacks for me at the time, and I remember investing in a company like Waco and Glanbia, and I know one of the reasons why I invested in those is because of their low price point. I couldn't afford to buy a Johnson & Johnson, or if I did, I only bought one share, and I felt like one share was nothing. I couldn't afford to buy a Microsoft. I couldn't afford to buy these big companies, and it was a barrier for me. So I used to invest in lower price companies, thinking I was getting more value for my money, but in actual yield and money back, I wasn't. So I think fractional shares actually make sense, because you can definitely focus on quality and ignore the price point, because you can still invest in these companies.
Yeah, and I would do something similar, and because with the learnings I have today, right, I would also watch out to only buy cheap stocks because you can get 5 share. I don't know, you can get 5 Ahold Delhaize for 150 euro. Let's do that instead of one share of Johnson & Johnson. So I would really watch out for that, and I would also invest more in fractional shares. I don't really do that now because I don't need it, but I would do that probably. I would make really use of that, not knowing probably then what's ahead of me, but knowing what I know now, I would then at a certain moment when I get more disposable investment income, switch the fractional shares off and go there. Because maybe we need to do a poll on our Facebook community, but I cannot imagine that people stay for a very long time in the 5 to 10% on their budget. I really, really believe that people, once they get the money mindset, start finding a way to increase their income and keep their expenses relatively flat. So it's really hard for me to imagine that people will not be able to make 20% savings rate after some fiddling.
Yeah, I think in the demographic that listens to our podcast, and obviously we can see the stats, I would expect most of our listeners could probably be upwards of 20%, if you look at the age particularly. But if you focus on maybe the younger listener, which we do have, just not as many, you have a choice. You come out of college, you go to work, and then what do you do? I know when I was that age, I wanted to go party, I wanted to go meet friends, I wanted to go socialize, and you can understand that. So they might stay in the lower bracket for a longer period of time until they get all that out of their system. It's generally when you hit 26, 27, that's when you start thinking, don't you? Okay, I need to buy a
How
house
do they
now.
call that? Jail?
Yeah.
Because you mentioned like you stop partying, you stop socializing.
Well,
Well, although
you-
in jail, I think you still have a lot of social
yeah,
contact.
yeah.
Yeah.
I don't think you stop. You're more selective, more selective
Yeah.
when you do it. Instead of doing it 4 and 5 nights a week, I might do it once a month.
I
Might do
think
it.
the hangover starts to be more difficult to overcome once we get older.
Yeah, yeah. All you youngsters out there, trust me, if you don't get hungover now, you will. Um, but yeah, no, I agree with you. I think over time it's definitely achievable to gradually increase that. What do you think is a good rate then to hit? What if you were to achieve something? Maybe 50% is not attainable, but what would you say, 30, 40%?
I think it's not so much about the percentage. I really think it is about being conscious with money, a bit of a frugal mindset for a few years, and then just max it out. I also believe your family shouldn't suffer from it. What I mean with that is you should go on vacation because those Kodak moments really make your life. But the question is, do you really need to go top season at a top-notch hotel, lying all day at the swimming pool, or are there alternatives? Maybe you can go a bit off season. Maybe you can go for a campsite one time and try it out with your kids, right? So there are alternatives to how to create those Kodak moments. And I think with this, you really need to break the system because when you turn on the TV, everything is geared towards pulling all the money out of your pocket. And they will play on your emotions. They will play on, you need to be in Mauritius for your wedding. You need to go with your kids, I don't know, to this hotel at the Costa del Sol. Yeah. So I think you also need to turn your emotions off towards those commercials. And I think you will be able to max it out. And whatever it will be, for some people, it will be 50%, for other 20%. I think that's all personal.
Yeah. Nice one. Yeah, look, I think overall I think it's a good topic because I think in the beginning it is quite intimidating, especially nowadays with social media, everything is amplified and you go on Twitter and you have these guys telling you they're making 1 million a week and 1 million a month and all this sort of stuff. And even some people posting their dividend income, they're looking at 5, 6, 7,000 a month. But I think what you have to realize is that does not happen overnight. It's hard work and consistency.
And how many users does Twitter have? And how many people on Twitter are able to claim those numbers? Yeah. So let's not forget that you're talking probably about a 20-year-old person there that just is super intelligent or just hit the jackpot with their family inheritance, or they're just entrepreneurs. They just know how to make money. But that's not me. I can tell you that's not me.
Yeah, not me either.
Yeah. Good. Yeah, no, I think it's really, really important topic for a budget. Guys, if you're on a budget and investing, just know it's worth it because you're buying time. Every time when you put this 100, 200 euro in the stock market, you will be thanking yourself 20, 30 years from now, because then when you are 55 or 60, you don't need to be stressed that much when you lose your job. You have a nest egg, then maybe you can use it for bridging then until your retirement if you're really in that bad situation that you can't find work anymore. Otherwise, you can just say like, guys, I'm getting too tired of working 5 days a week. You negotiate with your boss. Let me hand in 20% of my salary for a 4-day-a-week work week, or maybe 6 hours a day. That's what's ahead of you. Yeah, and if you like your job, you won the jackpot already. You don't need often a lot more.
Yeah. Nice one. Okay, we've got some questions from the community, so we might start with the first one, and it is from a regular listener and poster on Facebook, Marek, who has asked us, how often do you update your DCF for a given stock?
That really depends. Usually when I do my analysis, let's say once a year, I revisit it. I, of course, make some videos here and there. So then I do it a bit at that time when I'm looking into it again. But the thing is, you don't really need to. The idea is behind the discounted cash flow that you don't need to update it so much because you make a 10-year projection. So it should kind of stand for that time, right? Unless something really fundamentally changes. Let's take Intel or something like that, right? That starts to suddenly do a full turnaround. Yeah, then you need to take the lack of cash flow into consideration. But other than that, it should actually be a bit more stable there, I would say. So, yeah.
Nice. Jack has asked us, have you ever calculated your rough average annual returns?
No, never. No, never.
Yeah.
I mean, in my annual report, I look at it. So maybe, Jack, go to my blog, europeandji.com, and put in the search bar annual report. You will see that I compare my, what I did in the stock market. So I believe, what was it? Was it last year in 2021 where it went 20% down or 18% down? But then I was kind of flat because I owned energy stocks. But the fact that I can't even tell you that so much also means that it doesn't stick into my mind.
Yeah. I think I got my spreadsheet off a website called A Measure of a Plan, and I adjusted it for dividends. But on that, it does track your annual return in comparison to the S&P 500, and I know that I've been above the S&P 500 every year since I invested. I don't know what that figure is. I just know people are interested in that. I don't really care too much, but I've been above that for the last couple of years. I don't know this year. I don't know if I'm underperforming or look at the end of the year, but since 2017, I have been ahead of the curve, so to say.
Yeah, I think I'm underperforming because I track my portfolio value every quarter, and I could see that it's not increasing so much, and actually that most of my portfolio value, let's say, growth was contributed to by cash depositions and such, and dividends reinvested, which is also a return, dividends reinvested. But I believe the sum of all the buy orders I did, I think was larger than the delta in portfolio value between the two quarters, which means that my portfolio went down in that quarter. But again, I don't measure it. It's not so relevant.
Cool. Tim has asked us, what is your strategy on buying top quality? Do you overpay for it with dollar cost averaging, or do you sit tight for a drop into the value zone?
Yeah, the last one, drop into value zone, because I don't like overpaying for shares. But sometimes I feel like I've got L'Oreal and my foundational top 10 stocks as a desired stock there, and I still don't own shares after 3-4 years since I made that list. So, need to be patient. I truly believe, and I always tell myself, so maybe I don't truly believe, but I always tell myself that, I was able to buy Apple at a PE of 13. I was able to buy Microsoft at a PE of 15 or something like that. And they are in my top 10 positions, really having nice places. So it must be possible that sometimes high quality companies come down. I mean, if you look at non-dividend stocks, like where PayPal is trading now at around $58, for me, it's a high quality company in the payment industry. Yeah, I know there's a lot of competition there, but I think those opportunities do present themselves at times. We had Amazon going into the groceries and such. Ahold Delhaize at 15 or 16 euros at the time. Yeah, it went all the way from 24, 25 to 15 or 16. So sometimes there are these industry headwinds because of certain chains expected, and then everyone becomes doom and gloom, and everything trades down. Maybe China will put something in there that suddenly all the Louis Vuittons and L'Oreals all will crash really hard. Yeah, we see already the response to China in their stock prices. So, and then the question is this an overreaction or not? So, on the other hand, maybe I should just DCA a little bit and just buy a few shares. We have Martin who I'm sometimes engaging with, and he bought some ASML and these kinds of stocks, but he has a different horizon than me. I would like to retire in 4 or 5 years, or at least be financially independent.
It's a tough question sometimes, and I always get slightly jealous when you talk about Microsoft and Apple at the levels you bought them at. But then you have to remember when you bought them at them times, they were beaten down for a reason, and not everybody felt they were top quality. Apple was dead; it was dead and buried at the time.
They said iPhone is dead.
Yeah, exactly. So the perception at that time, in that moment, might have been that they were not a top quality company. It's proven.
Yeah.
It's proven over time that it has worked out.
Yeah.
But I mean,
Yeah, and there were also companies that I bought in those times that went down further. Yeah.
Exactly. And there could be companies out there now that we are not saying are top quality, that we could look back in 10 years' time and say, wow, that's a top quality
Yeah,
company.
think about CVS. I just did a video about them. Yeah, and now again they dropped yesterday 8%.
Yeah.
But maybe it is all an overreaction. I just don't understand the American market too much to have a feeling for it that this is indeed a top-notch quality. But if I
Yeah.
see downgrades by the regulators on their benefit plans, then yeah, I don't think it's top quality. Yeah.
Next question is from JC, and he says, hey, LVMH, Louis Vuitton, is
we have
going down. Getting interesting for you guys.
Yes, it's becoming a little bit interesting. The yield is still too low. I just looked it up when I saw this question coming in, and I will need to do my analysis. I never really analyzed Louis Vuitton as such from what I find it's worth paying for. So let's consider that one on the list to have a look at.
Isn't it funny? We talk about top quality stocks on this podcast a lot of the time, and we mention Louis Vuitton, and I don't think between your blog, my blog, or YouTube have we ever analyzed this company in depth. That's crazy.
Correct, because usually, but that's also maybe about YouTube, right? I put this video about CVS up. It doesn't get a lot of viewers, probably because the quality is not good enough. But what I've learned a lot of times as well is like also when I did a Siemens video, when the stock is not in the news, people are generally not so interested to watch it. So probably the people that loyally are interested in what I have to share, they always watch. But that's the core. But usually the algorithm picks up around that, and then when people see a YouTube thumbnail with Siemens on there, when there's nothing about Siemens and they have already in their mind Siemens is expensive, you don't click it. And Siemens was also I think trading 170 euro there, and I made the case like, hey, I'm doing this now so that I know when to buy it. Yeah, and I thought it was then 140 euro.
Yeah.
So there is something to this as well that prevents YouTube creators to create content that is not in the news or something like that, or not clickbait worthy. I'm not really paying a lot of attention to that because I do it also for myself, and I rather respect my audience also a lot. But on YouTube, yeah, the algorithm is in the favor of giving people quick content and effectively manipulating the crowd as well. But on the other side, the crowd also likes it and wants it. So it's a kind of a toxic relationship between the creators and the viewers. And I think the viewers need to be aware of that.
Yeah. Okay. We got a question here from Yoris. He's asking us, do you guys have a yield on cost in mind when you retire?
No, not really, because I have a yield on cost on investment at the moment, and I invest in mine. That's 3.25%. That's what I need, plus a 6% annual dividend growth. And whatever that is at retirement, I don't know. I assume still 3.25% somehow, because my portfolio is usually fluctuating between 3 and 3.5%.
Yeah. Let's put it this way. If I'm making more than what I'm making in my job at the time I retire, I won't really care what my yield on cost is. I only care how much the cash flow I have going through my account. That's pretty much what I base it on. Alec has asked us, let's assume there's a dip coming up. Are the companies that you would buy at a reasonable discount instead of going for really cheap stocks?
Yes, I mean, Texas Instruments all the time. I have my eyes on. I would like to have a bit more Starbucks. I would finally like to initiate one time a position in, I said, in Nike. So those kind of companies, I really love to have a L'Oreal or something like that. ASML again, I would look into. I think ASML on the low 500s is a nice deal. Yeah. Those kind of
Yeah,
companies.
I think ASML would be one of the ones on top of my list there. Really, I'm not too into Starbucks, but I think ASML, top quality, really expensive. And maybe if one of us does Louis Vuitton, that might get added to the list as well. I
Yeah.
really think Louis Vuitton and L'Oreal are two companies worth digging into a little bit more, just to see, are they actually worth overpaying for, if you get me.
So let's put it on the list. I think I will do L'Oreal, something like that, because I think they also own a little bit of Louis Vuitton. I don't remember exactly, but
Yeah.
let me look into that.
Okay, I might do Louis Vuitton because I like whiskey. So,
Good.
BT05. What do you think about Enagas and Rio Tinto at these price levels?
Well, so I bought Enagas after we discussed it in the podcast like 2-3 shows ago. I bought some, I think at 16 euros. I think it's now 15 euro 30. I checked before the show. Look, let's be fair, 10% dividend yield or something like that. That's why I own it. I don't expect dividend growth. Expect maybe a bit share price appreciation to maybe 17 or 18 euro. That's what I expect. But I'm in there for the high yields. I don't have any capital appreciation. I'm not in there for the capital appreciation. I treat it more like a 10% bond.
Yeah. And they do have a dividend floor for the next couple of years. I really like that.
Yes, and they have a relatively safe dividend, I would say.
Yeah. So I'm the same. I think I bought them a couple of weeks before you bought them. I've now 200 shares, maybe 250 shares in them. But like you said, it's the high yield, it's a safe dividend. And What about Rio Tinto?
No, Rio Tinto is a stock that I buy, like BHP Billiton, when we're talking about a commodity crisis, when it's all over the news, when everything is crashing. That's when I buy that, not now. It's for me, it's too quiet, out there.
Ivan has asked us about utility companies. There's a lot of them at the 52-week low. They pay 4 to 5% dividend yields. Are there any you believe have fortress balance sheets that you would buy?
Yeah, so I've ignored utility companies for many years. I've burned myself sometimes on them a little bit, in the sense of they talk sometimes about the toll gate model and such. And then, like Kinder Morgan, I know it's not entirely at the time a utility, but they cut the dividend while the dividend was safe, supposed to be. So I think there's not a really, there's a bit of an illusion around the dividend safety. And also Ian Lophook made a video today about this Hawaiian utility, saying like it was a widow and orphans stock, and then suddenly a natural disaster happens. Yeah, and utilities are heavily regulated. So I think I would do utilities more around 6 to 7%, knowing that they don't need to do major capex investments in the upcoming few years and actually come out of a capex cycle. Then I would maybe consider it.
Okay. We got another question from a name that I'm just not going to pronounce. But he's asking, maybe it's been discussed on the podcast, how do you guys get together in the first place?
Well, remember, it was Tinder for finance nerds. So I swiped you to the right, and yeah.
There could be a business model in there. I think we were born out of COVID. COVID has helped a lot of it broke up a lot of relationships, but it actually made new ones as well. So
yeah, so maybe just in here we were connected on Twitter, and we just I had the urge to not only tweet, but also just to hang out with people, because at home I have nobody to talk about about dividend investing. So then we got on a call, and then after it was such a nice conversation that they said, like, you know what, we should record ourselves one time, because there's nothing out there that talks about dividends like we do. At least that's how we felt. That's how we recorded our first pilot show. So it's probably the worst show we ever recorded. We were both nervous. I think I've been editing the word out every time. And yeah, anyway. But that's how it all started, right?
I remember that episode, and I remember my wife was listening in, and after the show, I went back and she was like, "Why did you sound like a robot?" And she peeped in, and I was sitting really stiff, and you're trying to talk, and it's quite a funny episode actually looking back. But hey, good times. 160 shows. Who would have thought?
Yeah, we could have born a few babies in the meanwhile.
Exactly. Dividend Gardner has asked us, a lot of quality dividend growers will need more than a decade to get an 8% yield on cost. Is Verizon, ticker symbol VZ, a shortcut to financial independence?
No, I don't think so, because I don't see Verizon as a high quality. Although I see Verizon as a better quality than AT&T, and the main difference is management. That's what I see here. But you need to really think about this. If you look at the total return, even with dividends reinvested, like who benefited for 3 decades of the biggest industrial revolution after the steam engine that we have seen, called the internet? They are managing almost the whole network for everyone to be connected in America, and they are not able to become a 50 bagger or something like that in 30 years. Now that tells you something. That tells you that they pay all the capex for others, like cloud service providers and everything, to benefit from. And so for me, I don't see Verizon as a shortcut to financial independence, but I do understand what he means, and we touched upon it earlier in the show. Like for me, buying 1%, 1.5% yielding companies doesn't matter if I want to be financially independent in 5-6 years from now. Yeah, I need to buy things more than 3%. Simple as that. That's what the math tells me. So yes, if I can get, like for instance, ASR NL, the insurance company, at a 7% yield, yeah, that's what I call more like a shortcut to financial independence. But again, you can go for a high yield portfolio. Just expect more dividend cuts along the way. But it might bring you quicker there. My stress level will probably also be a bit up if I would only have ASR in my portfolio.
I do get where he's coming from. It is hovering around an 8% yield, but if you look at their dividend growth on top of that, it's non-existent. It's 1% here and there, I think, over the last couple of years. So you're really in it for the yield that you get now. And even on share, you talked about total return. Their share price is the same price as what it was back in 1999. I mean, back then it was $33.60. It's $33.30 now. So you've got zero price appreciation. So it's really just the dividends that you're getting from this.
Yeah, but if you reinvest that, it might have been 2 or 3 times that. Then let's assume that. But then we just spoke about Enagas earlier, where you get it for 10%, European stock, where I believe the share price, well, probably like Verizon, has a bit upward potential, of course, because maybe they are both punished right now. Yeah, no, I try to not get into this thinking. Maybe I'm doing myself short with this. Maybe I could retire, because I could probably retire if I would sell my whole portfolio, which is yielding at 3.8%, and buy only 8% or 10% yielding stocks. I could probably do that. And some people do this, as well. They buy only such yield, and they really quickly. And sometimes I think even I play with the thought, and we discussed it in an earlier episode. Why not? Just buy it and then still work a few years. Don't call yourself financially independent, but keep reinvesting those dividends. Build your margin of safety up to 20-30%. It's a different strategy. It doesn't fit my stress tolerance.
Yeah, I read a book on this recently called The Income Factory, who specializes in higher yields, but particularly around closed-end funds, I have to say, but also includes some stocks in there. So if you're interested in that strategy, there's a couple of books out there. But that was a really nice read, I have to say. But again, like you, it doesn't fit comfortably with my stress levels either. I
Yeah.
have a portion of it that's high yielding, high risk, but overall, I don't want my whole portfolio high risk.
Yeah. Hey, and we overlooked one question. It's about General Mills. If we have any thoughts about General Mills. So generally, I must say I didn't speak about it. I didn't analyze it over the last half a year. But I think it's a high quality business. Maybe not high quality. It's a good quality business which has proven over time to grow its dividends. I remember before COVID that it was kind of struggling, and then COVID came, and of course everyone wanted to buy their soups. That was really, really. It was a lottery ticket that they won. Yeah, General Mills at the time. I can see it came quite down again. So at the moment, I think it's yielding around 3%, something like that now. I think General Mills is always a stock worth analyzing. For me, it's a little bit in the area of Coca-Cola. It doesn't excite me enough with the dividend growth and everything, but it has place in a portfolio. Yeah, not as an anchor stock, but I think you can count on management here to grow the dividends, to not make the balance sheet too bad. Yeah. So again, I haven't looked into it recently, but those are my thoughts right now about General Mills. I mean, people will continue eating soup also from a can, and I think during recessions even more.
Yeah,
because then you don't go to a restaurant but eat at home more.
Yeah, I think you're right. I think from a dividend yield perspective, 3.35%, as you mentioned. But dividend growth seems to have picked back up. I know they went through a period where it was relatively flat, but if you look at the 10-year annualized, it's 5%. If you look at the last 3 years, it's nearly 3.5%. And last year they did a big raise of 6%. So, I mean, it doesn't look too bad on that side either. As you said, you get consistency, you get someone that's looking out for their shareholders, a great track record. So yeah, definitely worth looking into. And then the final question came to me in an email from Jose from Spain, who I won't go through the whole email, but he seems quite comfortable in his dividend growth investing stock. And from the email, I get a sense that he's quite sensible and quite conservative, but he does want to try and fuel his income to shorten the path to financial independence, like most of us does. And he has now been considering options, which seems to be a trend that happens, doesn't it? When people get into dividend income, they see, okay, we might be able to shorten this, and they go with options. So he's reached out to me because he knows that I've used to trade them, and he can recall I mentioned some sort of problems I had with them. Now, I did respond to the email as well, but what I have said on the show is I don't think options in itself is a bad thing, but I think it depends on your strategy. I know we have a couple of listeners here in our core community group. One of them shares quite regularly on Facebook within a small circle, does quite well with options, but he has a strict strategy and only deals with dividend stocks and only deals with stocks he wants to own. Okay, and it works quite well. Where I went wrong, and I was quite clear on that, is that I started chasing yield. Like, I started to earn a lot more income from options than I was dividend income. I gave it a lot more attention, but I also chased yield or chased premium a lot more. So I ended up with a load of rubbish in my portfolio, some of which I still have today. I felt at the start of the year, and I remember speaking to you offline, but I'm online on this, I felt it was starting to distract me from my core strategy, which is why I took a step back. So certainly, I think if you have the discipline to use options only on core dividend stocks that you want to own or want to sell, if you're involved in selling calls, it can be a good way to help your income. But I don't know how much that will shorten your path to financial independence.
So I'm still doing this already for a few years, but I do it at such a small amount that it is adding to my income. But I would say it's probably the most conservative way.
Yeah. But if you look at portfolio size, even my one would be probably less than what is required. I think if you have a large portfolio, say you have a portfolio of 400,000 or 500,000, and you have lots of multiple of hundreds of stocks of a particular company, and you don't mind adding lots of multiples of the same company or selling lots of that, you could probably make a lot more money. But if you have, say for example, I have European companies, Enagas, you go look at the premiums on that on one contract, It's not going to make you rich. Look at BASF, look at Unilever, look at Johnson & Johnson. It's not going to make you rich. Do you get me? You need a lot. I think you need a lot of money there as well to make a lot of money on this, but it can certainly help. The odd 300, 400 a year, it can add up.
Yeah, nice one. Good. Hey, we came to the end of the show. Thank you so much, Derek. It just continues to be a pleasure to have this conversation with you on the Fridays. I hope we get back a bit better to the rhythm on Fridays again. The holidays are ending for us, so it should be possible. And yeah, I wish everyone a very happy weekend. If you're running or if you have been running during this show, I hope you had a good one, that your legs were nice, fresh. And yeah, see you next weekend again.
See you all next weekend. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.